All right, so today we're going to break down the real investment case for Bitcoin. We'll be using some fantastic analysis from Fidelity Digital Assets to kind of guide us through. The goal here? To cut right through all the noise and get straight to the heart of what gives Bitcoin its value. But before we get into the weeds, let's start with a really simple but powerful idea. Just think about this for a second. What if you could send money to anyone, anywhere in the world, just as easily as you send an email? No bank, no company, no government in the middle. That right there, that's the core problem Bitcoin was designed to solve. Okay, so to really wrap our heads around Bitcoin's value, we absolutely have to start with the distinction. It's a super important one, and honestly, it's something that trips a lot of people up. So you've got two things here. First, there's Bitcoin with a big B. The best way to think about this is like the internet itself. It's the whole system, the global network, the protocol. Then you have Bitcoin with a little b. If the network is the internet, then the lowercase Bitcoin is the email. It's the actual thing of value, the digital money that you're sending across that network. Big B is the system, little b is the asset. Now, this is where it gets really interesting. The main investment case for Bitcoin. It's not about treating it like a tech stock or some new payment app. Nope. The core idea is that Bitcoin is trying to become a monetary good. So its value doesn't come from profits or utility, it comes from its ability to be traded and, crucially, to store value over a long period of time. Sound familiar? Yeah, a lot like gold. So what makes something good money anyway? Well, if you look back through history, every successful form of money, from seashells to gold, has had these same key properties. It's got to be scarce, it has to be durable, you need to be able to move it around, you have to be able to divide it into smaller pieces, and each piece has to be interchangeable or fungible. Gold obviously is the classic example. And the argument here is that Bitcoin checks all of these same boxes. It just does it in a completely digital way. Okay, that all sounds great in theory, right? But here's the big question. How does this network actually enforce all those properties? I mean, there's no CEO, there's no central bank pulling the strings. Well, the answer is pretty incredible. It all comes down to the code. 21 million. This is the magic number. There will only ever be 21 million Bitcoin. That's it, period. And this isn't some promise from a company. It's a hard rule baked right into the software that's been running the network from the very beginning. This unchangeable cap is the entire foundation of its scarcity. So, how is that number protected? By a genius idea called proof of work. The easiest way to think about it is like a massive global competition. You have all these powerful computers, we call them miners, all racing to solve a super complex math puzzle. The first one to solve it gets to add the next batch of transactions, or a block, to the ledger. Now, because this takes a ton of real-world electricity and computing power, it makes it crazy expensive and difficult to try and cheat the system. And that's what makes it so secure. And this chart, it shows you Bitcoin's monetary policy in action, and it's brilliant. About every 4 years, there's this programmed event called the halving. It literally cuts the supply of new Bitcoin getting created in half. Just look at the chart. You can see how the issuance drops off a cliff with each event. This makes Bitcoin more and more scarce over time, and it's all automated, set in stone, right until that last Bitcoin is mined, sometime around the year 2140. Okay, so we've got the tech, we've got the theory. How does this all come together to build a compelling investment case, especially when you look at what's happening in the wider economy today? Really, it boils down to this. More and more investors are starting to see Bitcoin as a legitimate store of value, basically a form of digital gold. And it makes sense, right? We're living in an age of massive government spending and money printing. So an asset that has a supply you can actually verify is fixed, well, that starts to look incredibly attractive. People see it as a potential hedge against their own currency losing value, all built on top of the most secure computer network in the world. And this comparison to gold really helps put things in perspective. You can see here Bitcoin's total value is still just a fraction of gold's, but that slice of the pie has been growing. What this really suggests is that the market is starting to take its role as a store of value seriously, and you can see the money flowing in as a result. But what's really powerful here is how this whole system feeds back into itself. Bitcoin's growth isn't just random luck. It's driven by what's called a virtuous cycle, a powerful, self-reinforcing feedback loop. Okay, let me walk you through how this works. It all starts right here, with more people, more users, more institutions deciding to join the network. They see the value, so they buy and hold Bitcoin. So what happens next?
Well, you've got more demand chasing a supply that we know is strictly limited. It's basic economics. This naturally pushes the price higher.
Now, that higher price acts as a giant magnet for miners, those computers that secure the network. It becomes more profitable to mine, so more miners jump in, adding more and more computing power. This makes the entire network stronger and way more secure. And here's where the cycle closes and starts all over again. That stronger, more secure, and now more valuable network becomes even more attractive to a whole new wave of users. And boom, we're right back at step one, but the whole system is bigger and stronger than before. It's a powerful loop. But okay, to get the full picture, we have to be honest about the other side of the coin. No investment is perfect, and we absolutely need to look at the risks and the trade-offs. And Bitcoin, for sure, is no exception. So a lot of the risk comes down to this core engineering problem known as the blockchain trilemma. Basically, you can have three things: decentralization, security, and speed or scalability. The catch is, you can't have all three perfectly at the same time. You have to pick two. Bitcoin made a very deliberate choice. It went all in on decentralization and security, but that came at the cost of speed. That's why it's so good at being digital gold, but it also means it's never going to process transactions as fast as something like Visa. And that fundamental trade-off leads directly to some of the key risks you have to be aware of. Number one, the price is incredibly volatile, as we all know. The rules and regulations around the world are still being figured out, which creates uncertainty. And you have to remember, at the end of the day, its value comes from people believing it has value. If that belief fades, so does the price. So where does that leave us? Well, looking ahead, there's a really wide range of what could happen. You've got the super optimistic bull case, where a Bitcoin becomes the base layer for a whole new financial system. The more moderate base case is that it just solidifies its position as digital gold. And then there's the bear case, where it gets replaced by better technology or just fizzles out due to regulations and people losing interest. And that leaves us with the ultimate question, doesn't it? After all this time, is Bitcoin really the future of money? Or is it still just a grand, fascinating experiment in digital scarcity? Well, the truth is, nobody knows for sure. The answer is still being written, one block at a time.